Pune's housing market operates quite differently than purely speculative property hubs. Its long-term growth stems directly from a highly diversified employment engine. Long before it became a global IT center, Pune developed deep roots in heavy manufacturing and automotive engineering. Real, physical industries anchor this city's urbanization. That broad base matters because housing markets ultimately survive on income generation. Relying on a single sector carries enormous risk, but a wide variety of actual wage earners provides a deeply resilient foundation for long-term property demand. Right now, that foundation is facing a complicated macroeconomic test. India's interest rate environment has tightened significantly, pulling mortgage rates far above their pandemic-era lows. This chart shows exactly where the friction starts. In premium micro-markets across Pune, apartment prices have shot up 25 to 35%, while average IT sector salaries have crept up by only 8 to 10%. When you add a 2 percentage point increase in mortgage rates on top of those soaring prices, affordability compresses rapidly. For a typical 1 crore apartment, a buyer's monthly loan payment suddenly jumps from roughly 59,000 rupees to over 72,000. Which brings us to the core question of this stress test. Are current property valuations actually supported by household cash flows, or are buyers temporarily ignoring the math out of a fear of missing out? The quickest way to separate real value from speculation is to look at rental yields, the cash a property actually generates compared to its purchase price. In Pune's premium neighborhoods, an apartment costing 1.5 crores typically brings in about 4.5 lakhs in annual rent. That is a gross yield of barely 3%, and that is before accounting for maintenance or taxes. Let's examine the financial flow. A tiny 3% cash stream comes in, trying to offset a massive 9% mortgage cost going out. The math is inescapable. Buyers operate at a deliberate monthly cash loss to hold the asset. When your financing costs vastly exceed your rental income, you are entirely dependent on someone paying a higher price in the future. That financial structure is highly fragile if the broader economy slows down. To see how that fragility plays out at a city level, analysts track inventory absorption. They look past how fast developers launch new projects and measure how quickly those apartments are actually occupied by residents. There is a distinct danger zone in real estate when construction speed aggressively outpaces actual human habitation, leaving massive towers completely dark at night. A healthy market clears its unsold inventory in about 24 months. But when unchecked developer enthusiasm drives that cycle up toward 48 months, supply begins to suffocate the market. Transaction momentum often hides this risk initially. Buyers will temporarily keep signing contracts even as affordability deteriorates, driven by the anxiety that prices will keep rising. But eventually, cash flow realities dominate. If developers aggressively launch projects while actual property registrations flatline, market confidence has detached from end-user reality. That disconnect matters because real estate developers are exceptionally vulnerable to operating leverage. Builders carry massive fixed costs for land banks, government approvals, and ongoing construction. Because those overheads don't shrink, a minor 10% drop in buyer demand can entirely wipe out a developer's profit margin. On a balance sheet, developer A carries massive debt for land expansion, surviving only if buyers pay up front. Developer B relies on equity and strong cash flow, allowing them to slow construction and survive downturns without panic selling. When liquidity stress eventually hits that first highly leveraged developer, the result is immediately visible on the skyline: stalled projects and abandoned concrete frameworks. Rising prices easily hide a weak balance sheet during a boom, but when the economic cycle tightens, a developer's debt-to-equity ratio dictates who finishes their buildings and who vanishes. Pune's premium housing market is particularly exposed to one specific external threat: its heavy reliance on white-collar employment linked to global IT services. A prolonged slowdown in global technology spending and multinational hiring could quickly fracture this high-income buyer pool. That triggers a direct chain reaction. Buyers disappear, pre-sales stall out, and leveraged developers suddenly face severe pressure trying to refinance their loans. It proves that real estate is a highly liquid-sensitive ecosystem. The moment credit access becomes restrictive, the vulnerabilities unravel rapidly. Analysts are watching the early warning signals closely. Rising unsold inventory, desperate discount campaigns, and developers struggling to collect payments are all clear indicators of a market nearing its limit. A soft landing looks entirely different. We would see sustained improvements in rental yields and developers maintaining healthy operating cash flows, even if sales velocity slows down. Right now, Pune's housing market faces two distinct paths, entirely dependent on whether debt or fundamentals take the wheel. Because the ultimate survival of a housing boom is never dictated by the scale of its architecture or the enthusiasm of its investors. It is dictated by the quiet, durable reality of household cash flows.